Hey, Dan.
How you doing, Bob?
Good, good. Even with in light of what's transpiring in the stock market, which thankfully doesn't have a lot of our clients in dis-ease at this point, but it's definitely unsettling for a number of people, but something that we're very familiar with and prepared with, and that's why we're coming here together today. Dan had created a presentation a number of years ago to try and educate and help our clients understand the markets and volatility and so forth. And so we're at another transition or point where we're experiencing volatility, or let's say a decline in the markets, in the face of some new information that's come across. And that's, the Fed trying to quell inflation, also the war in Ukraine that's transpired, jam up in products that are able to distribute around the globe and so forth. So there's a whole host of headlines and informations. But what we want to try and do is really keep this simple, keep it basic, and try and help you understand why we feel confident that our clients are in a good spot, because they have a cash flow plan, a financial plan, and things in place, and we can go through market volatility in different times that have transpired. So I'm going to stop there with an introduction and let Dan dive into what the presentation that he put together to help you understand why we may say, hey, don't open your statements for a few months, or don't worry about what's going on in the short term. Let's focus on the elements that are important to you in the longer term planning and the things you can control. So Dan, that's going to be as far as I'm going to introduce. So please take us through what it is that you created here.
All right, thank you. All right, so when we're looking at this presentation, we're going to be focused on looking at the Russell 3000, which is an index that it seeks to benchmark the entire US stock market. So it's a good indicator of some experience you may have if you are invested in the US stock market. So if we take a look here at the first slide, what we're going to be looking at is the daily returns that you would see in the Russell 3000 index from September 10th, 1987, which is the start of the index, until yesterday, May 5th. So what you're seeing is a graphical representation of the daily swings up and down that the index has experienced. So if you look at it, Bob, you could kind of see that it almost looks like it's like a reflection, like a mirror image. Yeah. The blue lines on the top are similarly matched with the red lines on bottom, the blue being the positive days and the red being the negative days. And so this also just looks like a lot of noise. This almost looks like what you'd see like a visual representation of like audio when you're speaking.
Yep.
So volatility is one of those things where the more you ignore it, the less it becomes relevant to your emotional experience, your investment experience.
Sorry, I like your analogy on the noise, because the connection I make to it is what people get on the radio, on the television, the prognosticators that are trying to get you to act on your investments and make you feel like you're foolish because you're not doing something.
Exactly. Yeah, and we know that that's not something that can be done. At least it can't be done consistently in the sense of being able to pick and choose, what's going to perform good this day or this month, and what sector is going to perform or underperform. So, and this is what we are trying to demonstrate here. So if we instead of looking at daily returns, we now move it to looking at the returns on a monthly basis. So now you start to see a little bit more separation between the returns, but it's still a lot of noise. I mean, you can kind of see that you have some months here that have some pretty big swings down. You have some months that have some pretty big swings up. But there's not a whole lot you could take away from this as far as, what's my overall growth? How does this translate? And that's the reason that, again, we don't want to look at these things on a short-term basis. So now we start going out to quarterly returns. Again, same time period here, September 87, and then we're ending April of 22. And now you could start to really see that, maybe you could see it, that the blue lines here that represent the positive quarters are really starting to outweigh the negative quarters.
It's not as much of a reflection.
Yeah, not as much of a reflection. You could see different time periods, and you could probably guess what these are representing here. If you're going out, so like this is 22, you could probably guess that, Bob, this is the Great Recession over here.
Yep.
And then we have the beginning of the 2000s over here after the dot-com bubble burst. So if we now go to annual returns, this is where the picture really starts to change. And so if you go back to, we'll go back annually to April of 1988. So we have full years here. And you can now really see that all of these blue lines up here heavily outweigh the negative years. So it's a good reason why, if you're going to look at your statements at all, at least start with, annually. Looking at them monthly or quarterly is not going to do you any good, and especially looking at them daily when you hear headlines on the news or you see the market reacting to certain things happening in the world. And then the last slide here is 5-year returns trailing from the end of April here, going back to October 1987. And so you could see all of these 5-year return periods are positive. You did have one here, which again, this was after the Great Recession. So this negative return here of about 17% is taking place between 2007 and 2012, or the end of 2007 and the end of 2012. But the following year, and actually maybe I can move out of the way here.
Let me interrupt, Dan. What alls we're showing here too is the Russell 3000 index, and this is where the domestic market got really hurt. So I don't know if people remember the lost decade is what people called it in the domestic market, but that's where the S&P 500, which is a smaller subsector, it's the 500 largest domestic companies, was down or flat over those 10 years. Where if you had a diversified 60% equity, 40% fixed income, this is off the top of my head, I think the return was about 6.6% for an index diversified portfolio. So my point here is it's not a direct correlation or comparison, but it is showing that, okay, here's a 5-year period where this Russell 3 was down, but adding other asset classes to the mix would change the outcome here. And that's typically the way we recommend people invest, not just in the Russell 3.
That's right. And the big one there is the fact that we invest in non-US stocks, whereas the Russell 3000 is just the US stock index. Mm-hmm. And as you said, over that same period of time, when the broad US market was down about 10% over that decade, the average return in that globally diversified portfolio was up about 6.5–7% per year. So that's another reason why, when you are just looking at, if you're watching, the new CNBC and you see the S&P 500 down or the Dow is down 2%, 3%, that only accounts for a very small portion of the type of portfolio that we create for our clients. All right, so now that we have shown you that, volatility is more of a short-term problem, and it's really not only it's not really a problem, it's just an emotional experience, because we see that the longer you are invested and the more you stayed structured in your investment plan, the more positive the results will be. So what I wanted to talk about here was what we experienced more recently, to really show a good example of how irrelevant short-term volatility can be. So this is looking back at the peak of the market in 2020 when COVID first appeared, and from the peak of the market to the bottom of the market, which only took about 32 days, the Russell 3000 index lost about 33% of its value. So if you remember back then, there were huge swing days, up 10%, down 10%. The volatility was crazy, and it did go down about 33%. Now, that was definitely scary for a lot of people during that time, because not only are you dealing with a downward trend in the market, but we also didn't know what was happening in the world at the time and what type of impact that was going to have long term.
Like today.
Like today, exactly. And today, just to give you some reference, right now from the peak, the Russell 3000 index is down around 11%.
Yeah.
So while you've seen a lot of this volatility in the market and it feels like it might be more than that, it's really only about 11% at this point from the peak. And what I wanted to show on this next slide was if you just look at 2020 as a whole, starting in January 1st and ending December 31st, and January 1st, you close your eyes, open them at the end of the year, you're actually up 17% in this one particular index. So everything that happened in March was wasted emotion if you were really involved and looking at this on a daily basis. Because a 17% return in the market is excellent for a 1 year time frame. And then if we start looking at things going back 5 years trailing from yesterday, we had two pretty big events in the market. One was at the end of 2018 when the China trade war was heating up. And at the time, the market was also at a peak. We had a 25% drawdown over about 79, 80 days. So it didn't feel as sharp as I would say the COVID drop felt. But nevertheless, you have a 5 year period where you have a 25% drop here, a 33% drop here. And again, if you start here on May 5th, 2017, close your eyes and open them at the end, which would be yesterday, you're up 75%. That's total return, not annualized return. So again, going out 10 years now, while you could recognize these certain things happening and the big blips like COVID happening, it doesn't really make a big difference in your long-term investment experience. You're up 207% total return over 10 years in the Russell 3000 index. And that's after this 11% drop that we've seen from the most recent peak. So I just think that it's important, again, to think about these things when we talk about a plan that we're going to be creating for our clients, a retirement plan and an investment plan. And really, what is that investment plan based on? Is it based on things that are happening on a daily basis, or is it based on our long-term expectations for capital growth in the global market? And that's exactly what we want to do. So, of course, during times of volatility and during times when the market is seeing a drawdown and a pullback, that's when we're going to take the opportunity to, take portions of the portfolio that may be overweight at the time, which would be fixed income or bonds, and then get them back into the stock side of the portfolio to not only realign the portfolio to its original intended balance, but to also take advantage of the fact that the stock market is down right now. And that's the time you want to be buying more. You don't want to be buying when you're at a peak. So what are your thoughts there?
Dan, one of the things that's coming to my mind right now is us presenting this, you going through your risk presentation here. Some people may think that this is, we're not sophisticated and we should be able to dig in and with enough information, prognosticate movements before they happen or as they're happening and get ahead of it. And that thought process has been embedded in people's minds over the years to profit certain institutions, not necessarily the end investor. And so this presentation may not seem like it's that complex, but investing does not need to be that complex to have quality outcomes. And what you just talked about, we're doing the things that we can control, that we can focus on elements that will provide positive outcomes for our clients, removing the emotion from investing, which just, by the way, I think the average is around 66, 67% of the time, the stock market is going up. So if you want to participate, this is a time where it's going down. The most astute investors look at this as a perspective of like when they go clothes shopping, they want to buy something that's on discount or when it's on sale. But when a price goes down, that means the value of that purchase that you buying that has a higher expected potential return than when the price was higher to buy it. So it's the reaction is the inverse of what should be transpiring for most people. But because of the headlines and the concern and the unknown of what's in front of them in the short term, people react. And so what Dan is trying to talk about here is get you to expand and extend your thought process. And if you can see this as an opportunity to participate in the markets, and I'm saying going to whole hog in, no, don't throw all your money at this. Have a plan, have a cash flow plan, have a retirement plan, have a rebalancing strategy that Dan was talking about there to take advantage of these things. So, you know, from a broad perspective, I think there's opportunities here. And if you're astute and you have good guidance, you can benefit from what's actually transpiring here, and not through, you know, someone that's saying, hey, I got a great stock here. It's from disciplined investing. So
yeah. And I think the thing too is it's okay to, you know, be concerned about what's going on in the world outside of the stock market. Of course, we don't know what's going to happen at any given time or with any given event. So it's okay to be a little concerned, but as long as you understand that letting those emotions play into what your long-term investment plan looks like really is not going to provide any type of benefit to you long-term.
yeah. You should be asking the person that you're working with, where am I going to be? Am I going to be able to meet my goals? Focusing on the return that you're going to get. Yes, that's an important factor. Are you getting the returns that you need to meet those goals? And are you getting returns that are appropriate for the amount of risk that you're taking? If you're not, and those questions aren't being answered, then you need to find someone that will be able to answer them for you. So, anything else on this, Dan?
No, I hope this was helpful. I always like looking back on it just to see what's taken place, and it's always interesting to me. Yeah. So no, I think that's it.
Yeah, Dan, thank you again for doing this. I'm so glad that everyone in the team is constantly trying to find new ways to present complex information in a simple way that people can understand and digest, and gain comfort in knowing that that there's astute people trying to fulfill their objectives. So again, thank you for doing something that's not sensationalizing the information that's out there, and creating something that's viable and understandable for the people for the masses. So, all right.
Yeah, you're welcome. All right. Talk to you soon.
Bye-bye.
Bye.